It is the 17th of July 2023. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500. I am back after a longer than expected pause in these market update videos, and I do apologize for that. I intended to take a break of only a week or two because I was focusing on some very exciting projects that we are busy with that are approaching their final stages. One of those projects is particularly exciting. It is a new indicator for multiple platforms that focuses entirely on the FLD. And I have kept delaying these market update videos in the hope that I can give you a glimpse of that indicator. But we have hit yet another hump in the road on the way to developing that indicator, and so it is not quite ready yet, but I will certainly be showing you that indicator in the next few weeks. So let's take a look at our disclaimers first, of course, to keep the lawyers happy, and let's take a look at the S&P 500. This is a weekly chart, and because there has been a break since my last market update video, I would like to highlight a few important points. You will notice that in this analysis we have a 9-year cycle trough over here in December of 2018. The pandemic trough, or this very dramatic trough that formed in March of 2020, which I often refer to as the pandemic trough because it did of course occur at the time that the pandemic was sweeping around the world, which, as I've mentioned in previous market update videos, potentially caused a distortion in that trough. That trough has been phased according to this analysis as an 18-month cycle. Now, in previous market update videos, I have discussed the possibility that this trough in 2020 might have been the very important trough of at least 54-month magnitude, or was it this trough here in December of 2018? I'm not going to debate that point. It is still unresolved, but in my opinion, the recent bullishness that we have seen over the past several weeks confirms the idea that the important trough actually formed in December of 2018. The reason for that is because positioning the important trough, or the bigger magnitude trough in December of 2018, raises the magnitude of this trough that formed in October of last year. Now, this trough in October of 2022 was either a trough of the 18-month cycle, or, if this analysis that we're looking at on our chart at the moment is correct with the 9-year cycle trough in December 2018, then this trough in October of 2022 is in fact a trough of 54-month magnitude. Newcomers to the Hurst cycles approach are often a little taken aback by the fact that I can say that is either an 18-month cycle or a 54-month cycle. Surely there is a huge difference. This is the interesting thing about taking a Hurst cycles approach to analyzing your market. It might sound like a big difference, but in fact it isn't really. The reason for that is because if price was bouncing out of an 18-month cycle trough, we would expect price to form smaller magnitude troughs on its way to the next 18-month cycle trough in a manner rather like that. And if it was a greater magnitude cycle trough, in other words a 54-month cycle trough, we would expect the market to do a very similar thing, except for the fact that because we have a longer cycle pushing upwards, the move will be generally more bullish. And of course, in recent weeks, we have seen a strong push upwards, indicating that in all likelihood, the magnitude of the trough that formed in October of last year is greater than the 18-month magnitude that we have been considering, and is probably of 54-month magnitude. That would mean that this dramatic trough in March of 2020 was indeed an example of what Hurst called fundamental interaction, where news events from around the world impact the markets, usually by creating increased volatility, not actually by changing the movement of the market. In other words, price came down into an 18-month cycle trough, which was expected at about that time. In fact, it came in a couple of months early, but the important thing is that an 18-month cycle trough was expected at that time, and an 18-month cycle trough did form. But the fact that it pulled price so much lower than the trough in December of 2018 was probably a result of the news events sweeping around the world. And in previous market update videos, I've compared this with an analysis of the Nasdaq, which did not, in fact, form a lower trough in March of 2020. So what is happening now? Let's zoom in and consider the price action that we have experienced since the trough last year, which, as I've mentioned, is probably of 54-month magnitude. The first trough that we can see is the 20-week cycle trough, which formed over here in the middle of March. And we had a very clear and clean M shape, which is, of course, the shape that cycles make in financial markets. And if you don't understand the concept of an M shape in the markets, I would encourage you to download the 10 Core Concepts document that you will find a link to in the description below this video. And so we had a very good, clean M shape for the 20-week cycle. Since then, however, things have gone a little pear-shaped, or at least they're certainly not looking very M-shaped. What is happening? Well, in fact, all that is happening is that some extra bullishness has come into the market. I would like to point out that this is not very unusual following a high magnitude trough. I don't really have time to discuss it in today's video because I am keen to keep today's video fairly short, but I would encourage you to go back and take a look at many examples of big magnitude cycle troughs where you will find that the first full cycle of a shorter cycle trough, often the third or fourth cycle down from the cycle that formed the bigger trough, gives you a very clean and not very bullish shape. And the bullishness only actually kicks in after that. And that is exactly what we have seen here. Following that 20-week cycle trough in the middle of March, the next cycle trough that we expect to form is, of course, the 40-week cycle trough. You can see here a very spread nest of lows. These circles and whiskers are spread over to the left, but I don't take this 40-week cycle circle and whiskers too seriously because of the fact that it is based on the past 6 iterations or 6 waves of that 40-week cycle, which is going a long way back. And we have had a major cycle event occur fairly recently, which is, of course, this 54-month cycle trough in October of last year. And when a major cycle event or a major trough forms in the market, you would expect the wavelengths of the cycles to adjust accordingly, because the underlying trend of those cycles changes fairly dramatically because of the number of longer cycles that have changed direction. And so for that reason, following a very big magnitude cycle trough, you will often see these rather straggly nests of lows with the longer cycles really out of touch with what the current wavelength is of the shorter cycles. So for that reason, I will often ignore those longer cycles and focus more on the shorter cycles, which are, of course, measuring a shorter distance back to calculate their recent wavelength. You can see that the 40-week cycle trough is expected around about now. I'm looking at a weekly chart here, so it's a little rough, but we're expecting the 40-week cycle trough sometime within the next few weeks. So what is happening here? And this is why I have titled this video Finding Troughs in a Rising Market, because when you have a lot of cycles pushing upwards, we have the 54-month cycle, we have the 18-month cycle, and of course the 40-week cycle, which should now be pushing down, but we have a lot of bullish pressure. When you have that bullish pressure in the markets, it can be very difficult to identify cycle troughs because that bullish pressure will simply ride over the shorter cycles. Cycles don't disappear according to Hurst's approach to understanding the way in which cycles influence financial markets. There are some cycle approaches in which cycles completely disappear. They will appear for a while and then they simply disappear and different cycles appear. Hurst cycles is not one of those approaches. These cycles never disappear, but they are sometimes overshadowed by the influence of longer cycles, with the result that you get what is called a straddled trough, or sometimes I refer to it as a subtle trough. A straddled trough or a subtle trough is a trough where price doesn't come down very strongly into that cycle trough. One of the dangers of being a cycle analyst is that we tend to focus on the troughs and then, of course, the peaks, but the troughs are easier to focus on in a stock market because of the fact that the troughs are synchronized. And so we focus on those troughs and we keep saying to ourselves, well, the market is rising, but it must soon come down into this cycle trough. That is dangerous because we are looking ahead to the next event, which might be a disappointing event. If this 40-week cycle trough turns out to be a straddled trough, then it is quite possible that price will hardly move down at all into this 40-week cycle trough. I'd like to demonstrate that because we've had several examples of that recently. Let's change to a daily time frame and zoom in. Here is our 20-week cycle trough in the middle of March. If we measure the number of bars or the number of days that have followed that cycle trough, you know that at about 68 days there should be an 80-day cycle trough. What was actually happening in that market at the time? You can see the price action. There was a potential trough that formed over here at 52 days. Was that a very early example of an 80-day cycle trough? It's possible, but not very likely. What about this trough over here? At 60 days, that was only 2 days of downwards price movement. There's a tiny trough over here at 64 days. Was that the 80-day cycle trough? Or what about this position over here at 72 days, where you can see the software in its analysis process has in fact positioned the stack of diamonds representing the 80-day cycle trough. So was that the 80-day cycle trough? In my opinion, it was. But why didn't price come down for at least 40 days into that 80-day cycle trough? The reason is because of the bullish pressure of the longer cycles. And so when we have bullish pressure, we cannot constantly be saying to ourselves, I'm waiting for price to move down into that trough that I am expecting, because sometimes that move down is not very impressive. And it is quite possible that the move down into this 40-week cycle trough is not going to be very impressive. We have seen no evidence yet that the bullish pressure in this market has subsided. It's an interesting thing because people will often say, but a 40-week cycle is such a big cycle. Surely there must be strong evidence that price is moving down into the 40-week cycle. Well, you can keep extending the magnitude of the cycle trough, and you can say the same thing about an 18-month cycle trough or even a 54-month cycle trough. The truth is that it doesn't matter the magnitude of the cycle trough. If there is bullish pressure in the market, then a really big magnitude cycle trough could in fact become a straddled trough. What we should be focusing on now is not trying desperately to identify the position of that 40-week cycle trough, and also not waiting for price to move down sharply into that 40-week cycle trough. It might, but what we should be focusing on instead is the bigger picture at this point, because trying to identify the shorter cycles in a strongly bullish market can be a waste of time. So let's consider where this market could go to and take a look at the slightly bigger picture. First of all, where could the market go to? Well, let's consider the 20-week FLD. You know that I like to trade a sequence of interactions between price and the FLD, and following a trough of at least 18-month magnitude or a 54-month cycle magnitude is good enough. You can see that the first interaction that we had between price and the 20-week FLD, and we're looking again at a weekly chart here, is an A category interaction where price crosses above the FLD and generates a target to the upside. That target, as a matter of interest, was achieved last week, which is one of the reasons why I felt I had to make this video this week. It was achieved fairly late, I should point out, because there was another interaction between price and the FLD, and that was a particularly interesting interaction. As you can see, over here, price came down to the FLD and found support. It pretty much tracked along that FLD, as you can see, without actually crossing below it, or at least the median price did not cross below it, and it finally pulled up and away just a few months ago. So that is a very complex and long drawn out interaction. How would we label it? Well, it is labeled a B and C category interaction, what I now often refer to as a B and C category pair, because the BC category interactions often occur as a single interaction, if you like, where price comes down and finds support at the level of the FLD. When does it do that? You should know this by now. It always does that at about the time of the first trough of that cycle following the bigger magnitude cycle trough. And so here is the 20-week cycle trough in the middle of March, and in the middle of March you can see that the 20-week cycle FLD was indeed providing support to price. The next interaction would be labeled the D category interaction, and that is where we would usually expect price to cross down below the FLD on its way down to the 40-week cycle trough. But bear in mind, we have witnessed a tremendous amount of bullishness, indicating probably that the 54-month cycle trough lies behind us. Are we expecting price to cross down below that FLD? Not really, because the time for the 40-week cycle is upon us, and it seems very likely that that 40-week cycle trough will be a straddled or subtle trough. So I am certainly not going to be waiting around for price to cross down below the 20-week FLD. It could, in fact, find support at the level of the FLD, which is not usually expected, but it does sometimes happen if there is a tremendous amount of bullishness in the market. The important thing about this FLD for the moment is the fact that it has now achieved the target generated by crossing price way back over here in November of last year. That doesn't mean that the upward move is over, but it does indicate that we should see the push upwards begin to weaken because of the fact that the cycle target has been achieved. Here is the 40-week cycle FLD, and you can see there was an interesting confusion of interactions, if you like, with price crossing up above the FLD over here, then crossing down below it, and then finally crossing up above it over there. This is a complex interaction, which was discussed by Hurst in his Hurst Cycles course, and that generates a lower target, which I think I'm correct in saying was actually achieved over here in February, after which price came down and found support at the level of the 40-week FLD. Again, not entirely unexpected. That formed a little early at the 20-week cycle trough, and now as the 40-week cycle trough forms, we would expect the 40-week FLD to provide support. Does that mean that I expect price to come down to the 40-week FLD? There has been so much bullishness in this market, and the 40-week cycle time is due, and so I think it is unlikely that price will come down and find support at the level of this FLD. The final FLD that we can consider in terms of understanding where this market is going is the 18-month cycle FLD, which, as you can see, was crossed to the upside in March of this year, or this is now a monthly chart. I've changed the scale of the chart to a monthly chart, and so it was crossed between February and March. In fact, I think the median price of February was just about over that FLD, and so officially it crossed in February. Nevertheless, it generates a target just above the price level of 4,600, and so we still have a little further to travel upwards to achieve the 18-month cycle FLD target, which is perhaps why we have seen such bullish pressure, because the market is heading up towards this FLD target. FLD targets act a little bit like magnets to price. Price really wants to get up there and achieve that target, and I would not be surprised to see it do that. As a matter of interest, this very high magnitude cycle trough in October of last year could possibly be an even greater magnitude cycle trough, indicating that when the next 18-month cycle trough is due early next year, this 18-month cycle FLD might become very important to us, because it might provide us with a level of support for the market early next year. Now let's consider the composite model line, which is a very useful tool in Sentient Trader that takes all of the information from the cycle analysis, recomposes it to produce this composite model line, which should not really be mistaken for a projection or an exact projection of where price is going in the future. What it is simply another way of visualizing the analysis on our chart, because it is taking the information from the analysis. You will notice that the composite model line matches on this weekly chart fairly well up until the market starts stretching upwards recently, at which point the shorter cycles were clearly pretty much crushed by the longer cycles, and so this fluctuation that has been expected by the composite model line is simply not reflected in price. Does that mean there is something wrong with our analysis? No, it doesn't. It simply means that the markets have developed more bullishness, probably because of the high magnitude cycle trough that occurred in October of last year. The composite model line does warn about the fact that price is not coming down when we would expect the cycles to be pushing it downwards. Again, it doesn't mean that there is anything wrong with the analysis or that the cycles have failed. It simply means that that 40-week cycle is probably being completely overpowered by the longer cycles that are pressing upwards at the moment. And so again, I will not be watching for the strong move down into this 40-week cycle trough. It might occur, but I am expecting that the 40-week cycle trough is going to turn out to be a straddled or a subtle trough, the kind of trough that ends up making Hurst cycle analysts look foolish because they've been speaking about this cycle trough and then nothing happens. What I am instead expecting to happen is that after the 40-week cycle trough forms, and of course it is just possible that it has come in already, but after it forms we're going to see continued bullishness. We will eventually see a peak in the price action, and then we are expecting the cycles to turn lower to bring us down into the 18-month cycle trough. But that peak is not upon us yet, in my opinion. How are we going to know when that peak has arrived? We will, of course, be watching our FLDs. So let's take a look at some shorter FLDs and consider what is happening with these. Let's zoom all the way in and discuss how we will identify this peak forming in the market. These FLDs are now forming something that is approaching a cascade pattern. A cascade pattern is when these FLDs are very neatly lined up in parallel lines. Of course they're parallel because they're all based on the median price, but you can see there was a cascade pattern. Let me show you over here. This was a cascade pattern, and what happens is price crosses down below an FLD, generates a target below that, which carries it below the next FLD, generates another target which then might carry it below the next FLD, or sometimes it ends up in what is called an FLD pause zone, where it fails to get below the next FLD and then continues moving upwards. So we have a cascade pattern beginning to form. Price, and I'm recording this video before the US markets open today, so don't take this little bit of price action over here very seriously. Price is possibly crossing down below the 5-day FLD, but it hasn't done so yet. As it begins to come down through these FLDs, which it will do eventually, of course, we will be able to generate targets for the downside and be able to accurately decide where the 40-week cycle trough is going to form. I do hope you found this market update useful and interesting. Apologies again for the big delay since my previous market update, but I promise you we have some exciting things coming up soon for Hurst Cycles enthusiasts, so stay tuned for those.